So I wanted to share a little bit about on the covered call section and protective puts and all of these different combined strategies that we're utilizing or that we are going to be covering over the coming weeks and months.
But before we get started, the disclaimer. You have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than the investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. And again, these videos are for educational purposes only. You must do your own due diligence and research before setting up any of these strategies in your live account. But please do practice them in your sim account immediately so that you can start to get used to how each of these strategies work as there are changes in the market throughout the day.
And one of the key things that oftentimes people are forgetting is that, they see the profit in that morning momentum and they're worried that they're not really sure what's going to happen over the coming weeks and the coming days. And so they see profit, take profit, and close their positions. But I would always encourage you to try and consider finding some strong underlyings that move consistently and try and give yourself a bit of long-term exposure to the growth of the market. And so one of the things that I often talk about, if you are maybe only joining us recently, but for those who have been with me for the last year, I talk a lot about covered calls, debit spreads, and diagonal spreads. And those three strategies are really very closely related to each other. The main question between the three of them, or the main difference, is how long the long position is and how many days to expiration is the short call position on top of it. So over the last year, I have been trying to give myself more long-term exposure to solid moving ETFs that don't move a lot, but they move very consistently, like QQQ and SPY. And so one of the things that I did, I had a really nice momentum move or swing trade back in around like September time. It was, or at the end of August, around here, when things were doing really bad. I had gotten into a long put position and closed it in that morning momentum down move, and ended up with a bit of cash that I thought, I really want to use this opportunity where it looks like the market may be pulling back a bit to get into some long holds. And so I decided on SPY and QQQ to actually enter some debit spreads. And so what I did, well, actually they weren't, so some debit spreads. So I got them about 2 months out, and so I bought the long call and I sold above it at the 20 delta. Well, we all know then what happened. We kind of went through this little slumpy period, and I probably got in too fast because I was just wanted to see how these debit spreads would work. So my short position was actually hitting 100% quite quickly. So I was closing them, and then when we would come back up a bit, I would put a new one on, and then when we'd have a down day. So my short positions were actually giving me a bit of time for the long positions to get better set up. And so actually the entire debit spreads were pretty much red for this entire time. And I thought, man, I time this totally wrong, because I was expecting with options expiration that around here, once we were out of options expiration, that we would potentially bounce back up and then carry on up for the rest of the year. But I knew September would be an ugly month. So this did not entirely scare me because I still had time on my positions. And so what I ended up doing is I did end up with my debit spreads that were right around here. I did end up making a bit of money on the short calls, but the long positions I had a really good position. And so I just sat in it while it was like back here at the 360. And so then the minute that we started rolling back up, I was still selling above. And because of the fact that we had this downward momentum, I had already closed the initial long position, the initial short position that was on the debit spread, because it was already hitting like 60% at this time. And then when we bounced back up, I added a few long positions that were of the same expiration date as the original long positions of the debit spread. And as we moved up, I rolled the date out so that I would have a bit more time, because I wanted these long positions to at least stay on for the month of November. So I stayed patient, even though things were actually during this period quite ugly. And I was selling puts against the position. I was selling calls against the position. So I was trying to sell around it while protecting that long position. And as we dropped down, I did add some to the debited position, right? So I would just like to show you that when you are flexible, this is, so you can see that I have the long position here that's expiring the 26th of November. And I've just let this, I actually not even paid attention anymore to the long position. And I'm just constantly have been selling above it. And as you can see, I have a covering on that long position that's actually expiring next Friday. I have the covering that's expiring November 12th. Well, yeah, next Friday, the 12th of November, 2021. But over these last months, I've just let a QQQ do whatever it wants to do. And now look at where my position is. And this is actually a bit negligent of me, because I did not realize that I had gotten so far in the money with these long positions, because when I got them, I was at the money, and then I was actually out the money because price was actually moving against me. So just having that 370 long call, and I got them when I bought them one strike out the money. So right now, let's say that if I was looking to actually get something that was one strike out the money, the value of it would be $4.30, $4.77, right? If let's say it's for the same expiration date, but currently, because I've just left this thing go as deep in the money as it wants, I am now at a value of 29.22 on these long call positions. Now, I should have actually been paying more attention to the long position and not just managing the short positions against it, and actually been rolling this back up, because I thought I had been rolling all of my positions back up to the 80 delta. I wasn't actually trying to get to one delta. And I've been in the one delta for the last like $10. So this is actually really crazy that I haven't rolled this up. So literally now I could do a couple of things, right? I could just close this position, take my profits, and then reposition it better. That would probably be the most logical thing, because the expiration is coming, and I could roll this all the way up to 383, or maybe that's 382 strike price, and still be at one delta. But in order to get that leveraged feeling, I don't need to be at a 1 delta. I mean, being even at a 70 delta is amazing, because it basically means that every time QQQ move was $1, I am getting let's say the 77 cents plus 2 cents plus Vega, or which is actually getting me a really good rate of return. And actually, once you hit 1, you don't get any more gamma, you don't get any more Vega. So actually, the amount of money that I'm making per dollar move on QQQ is actually has not been efficient. Actually, that's the most hilarious thing about this, is that because I'm so deep in the money, yes, the value of my underlying is increasing because of the position is increasing, because as you go deeper in the money, the bid ask obviously reflects the actual value of QQQ. But in order to get that leveraged benefit, I should have been rolling up and expanding my number of contracts from a long time ago. And I don't know why I never saw that this was happening. And in part because QQQ has just been so bullish these last 2, 3, 4 days, that even when I've been rolling up my positions, I just haven't been able to keep up with the speed at which it is moving. So I just wanted to encourage you guys, sometimes having a few positions and just for honestly, in a way, just forgetting about them, as long as the underlying is doing what it's supposed to do, which you will see in your account that you are still in the green, that having a few of those longer term, long calls and just letting them sit, even when you only have maybe 4 or 5 contracts, but that you entered when they were a little bit out the money, so it was cheaper. But then just a couple of months later, on something like a QQQ or a SPY or one of the other spider ETFs, as you move in the money, the amount that you're making per contract starts to exponentially grow your account. So I would really encourage you guys, don't make all of your strategies scalping strategies or morning momentum strategies. Have some strategies that are open and remain open for, months and months, to get a bit of a feeling of that buy and hold aspect of trading or having an investment account, and protecting yourself when you are at these all-time highs, entering the position immediately with a short position on, so that you are constantly bringing in income. And as you can see, my long position isn't expiring until the 26th of November. But, I'm selling, actually I sold this 3 weeks ago. So I'm not selling against it every single day, but I am making sure that there are short positions against all of my long positions, so that I am growing my account. And as you can see, I have positions on QQQ all the way out to the 18th of March, 2022. So I have a smattering of long positions, and I probably actually need to add to these positions, since my 26 November longs are going to be expiring here anytime soon. And against all good reasoning, I had not been rolling up this position, and that is just so negligent on my side. I did miss an opportunity to actually keep expanding the number of contracts I had, because every time that I would have rolled this up, I would have been able to grow the number of contracts that I had, because I would have been essentially simultaneously selling at the 29.22 or the 28.90, somewhere in between the bid ask. And by buying higher up, where I'm still getting a close to a 1 delta, I would have been able to almost double my number of contracts if I would have come all the way up here to the 383. So, it was unfortunate that I missed that. And I haven't been giving myself any exposure to gamma or vega values because now I'm in the 1. And once you hit 1 on the delta, you don't get any more exposure to any of the other values, positive values inside your option chain. But that is now irrelevant. It is what it is. But I just wanted to show you what that looks like when you start to go deep in the money, because I think that a lot of times we feel discouraged about sitting in these lower value ETFs, sitting in them for 3, 4, 5, 6 months in order to let our long position go deeper in the money, because we're just afraid of losing the profits. But if you are selling against it and you are selling consistently and conservatively, you will always be making a bit of cash in the short term while you're letting the long position, have the chance with time to start exponentially growing. So I hope that was encouraging to you guys, just seeing that actually on the option chain, and that it's encouraging to you, and that it really pushes you to dig deeper into how the covered calls work. And in the next series, once we move to the butterfly room, we will dig deeper into debit spreads and my favorite diagonal spreads, which are very similar to a long position with a covered call. All right. Bye for now, friends.